फ्रेंड्स, वेलकम टू माय चैनल। दिस इज सीए राखी अग्रवाल। आज का हमारा टॉपिक है इंडियन अकाउंटिंग स्टैंडर्ड 109 107 32 which talks about financial instrument part 12. In today's discussion we will discuss about the recognition and derecognition of financial asset and financial liability. What are the conditions? What do you mean by derecognition? Today we are going to discuss that of financial asset and also financial liability along with some examples. So let's start our topic. Firstly, we will discuss about the derecognition of financial asset. What is derecognition? Derecognition means when the control over the asset or control over the asset is transferred to another person, or when control over the asset and risk and reward of the financial asset has been transferred or lost. How? How it will be transferred? By way of sale. There are various conditions of derecognition which we are going to discuss. Like if by control of financial asset, risk and reward is transferred by way of sale of that asset. If the control of the financial asset has been transferred, risk and reward of the financial asset has been transferred, right to receive the cash or bank has been expired. In case of bankrupt, if any bankrupt has been taken place, then in that case also right to receive cash has been expired. In that case also the asset is to be derecognized. If the asset is sold, if the asset has been transferred, risk and reward of that asset has been transferred, in that case also it will be derecognized. So these are the conditions which need to satisfy in order to check whether derecognition is there or not. Now, what do you mean by the control and risk and reward? When the risk and reward, we have to check two conditions. Firstly, when risk and reward are transferred, in that case how we will account, how we'll make the derecognition. And if when the risk and reward of the financial asset has not been transferred, when risk and rewards are transferred, derecognize financial asset from the books, sale of financial asset as per INDAS 115, and there is no condition to repurchase. Means sale of transfer in such a way, as per accounting standard 115, that sales takes place and there is no condition available in that contract to repurchase that financial asset. In that case it will be permanently derecognized from the book. Sale of financial asset. Now there is a sale of financial asset with condition or with option to repurchase that financial asset at fair value. In that case, how it is to be accounted for, we will check that also. Then derecognize financial asset when the normal sales takes place, when there is no condition to repurchase, when sales takes place with a condition to repurchase, and transferor has a call option to purchase, means there is a call option to buy the asset. Such option is out of money. Out of money means when the strike price is greater than market price. In that case, what happened? When the strike price of the financial asset is greater than market price, then in that case the transferor will not exercise the option and he will derecognize the financial asset. He will not purchase, then he will derecognize the financial asset because the strike price is greater than market price. Transferor has put option and such option is out of money. In case of out of money means when strike price is greater than market price, then in that case transfer will not exercise option and derecognize the financial asset. Interest rate swap. When fixed rate of interest is transferred with variable rate in such a manner that it is equivalent to the principal, then derecognize financial asset. when the fixed rate is transferred with variable interest rate in such a manner that it is equivalent, means the financial asset is equivalent to the principal, then in that case it will de-recognize the financial asset. Now we will discuss about the when risk and rewards are not transferred. These are the conditions of risk and reward are transferred, then the asset is de-recognized. In case when risk and rewards are not transferred, continue to recognize financial asset, no need to de-recognize. When sale of financial asset has not been made, means sale takes place not happen as per INDAS 115, no need to de-recognize, continue to recognize as a financial asset. Sale of financial asset with repurchase option and price of repurchase is either fixed or margin is fixed. Means sale of the financial asset with option to repurchase when the price of repurchase is fixed or margin is fixed, in that case no need to de-recognize financial asset, continue to recognize this as a financial asset. Transfer has a call option to purchase, such option is within the money. Within the money means when the strike price is less than market price, in that case transfer will exercise the option and recognize the financial asset. In that case, transfer will exercise the option and recognize the financial asset. When the transfer has a put option and such option is within the money means when the strike price is less than market price. In that case also transfer will exercise the option and recognize the financial asset. When the transferor has given guarantee for any credit loss, then also he will recognize the financial asset. Interest rate swap, interest is not linked with principal. When the interest is not linked with principal, then continue to recognize as a financial asset. Now this is to be explained with the help of example. Repo agreement means repurchase with an option to repurchase a financial asset. Suppose company A sold its financial asset to B Limited with an option to repurchase where the price for repurchase is fixed or sale price or margin is fixed, then in that case it will not be de-recognized, it will continue to recognize the financial asset. So company A will continue to recognize it as a financial asset, and hence this financial asset will not be de-recognized as the repurchase price is fixed or margin or return margin is fixed. In that case it will continue to recognize as a financial asset, no need to de-recognize and again recognize. It will continue to recognize as a financial asset, no need to de-recognize such financial. Example 2, company A, that is the transferor, sold its financial asset to B Limited. If the transferor sold its financial asset to B Limited, company A is having a call option which is deeply in the money, means in the money, and he has an option, call option. In case if the call option is there and it is in the money, then in case of transfer, when the strike price is less than market price, strike price is 80,000 and market price is 1. In this case, where the strike price is 80,000 and market price is 1 lakh and call option, A Limited is having a call option which is deeply in the money and strike price is less than market price, then the company will continue to recognize the asset. He will never de-recognize, because in this case, in case of call option where the strike price is less than market price, then the company will continue to recognize the asset. He will not de-recognize the financial asset and then again recognize. It will continue to, company A will continue to recognize the financial. Now example 3, company A, that is the transfer, sold its financial asset to B Limited. Company A is having a call option which is out of money. Out of money means Out of money means when the strike price is greater than market price. Then in this case, strike price is 1,20,000 and market price is 1 lakh. And it is a call option which is out of money. Then in that case, the strike price is greater than market price. The company A will de-recognize the financial. Now example 4. Company A sold its financial asset to B Limited. Company A is also having a call option which is readily obtainable from market, that is neither deeply in the money or out of money. In this case, the company A will de-recognize the asset because it is neither in the money or out of money. So A will de-recognize the financial asset. Example 5. Company A, that is the transferee, has a put option. If transferee has a put option, then put option is deeply out of money. If the put option is deeply out of money means where the strike price is greater than market price. In this case, strike price is 1,20,000, market price is 1 lakh. Then the strike price, as the strike price is greater than market price, the company A will de-recognize the financial asset. In put option, if the in case of if the deeply in the money where the strike price is less than market price, in this case the strike price is 80,000, market price is 1 lakh. In case where the strike price is less than market price, company will continue to recognize financial asset. In case where strike price is greater than market price, then company will de-recognize the financial asset in case of call option and in case of put option. Now example 6, suppose an entity may transfer to the transferee a fixed rate of financial asset that is paid off over a time and entered into an amortizing interest rate swap means give given variable rate of financial asset and receive fixed rate of financial asset. It is an interest rate swap where the entity gives a variable rate of interest and receive a fixed rate of interest. Interest rate swap amortize so that it is equals to the principal amount of the transferred financial asset. When the interest rate swap amortized, so it is equals to the principal amount of the transferred financial asset. In case when the interest rate amortized and it becomes equals to the principal amount of transferred financial asset, then it will be continue to recognize as financial asset. And if the amortization of notional amount of swap not linked with the principal, if the amortization of interest, notional interest which is not linked with the principal, in that case it will de-recognize the financial. Factoring means a party who collect your debtor on your behalf in case you do not have manpower to collect. Suppose A Limited had sold goods to B Limited for rupees 1,000 for a credit period of 3 months. But A need money on urgent basis. So he goes to bank and enter a contract for discounting of a debtor. So he received rupees 900 out of 1,000 and 100 is given to the bank as bill discounting charges. So and ultimately after 3 months bank will receive rupees 1,000 from B Limited because A Limited has discounted that bill with the bank and collected 900 out of 1,000, and after 3 months when the period is over, bank will ultimately receive the money or collect the money from B Limited. So here in this case bank is acting as a factor between A and B because ultimately the debtor is of A Limited, but A Limited has given its debtor, pass on his debtor to the bank, and bank now A Limited is free from that. Now bank will collect that debtor after the period is over, after the credit period is over. This is the meaning of factor. There's type of factoring are there. Recourse factoring is there and non-recourse factoring is there. Recourse factoring means is that the company has an obligation to pay. Means in recourse factoring what the responsibility is on the company who has given his factor to another. Means who has given his bad loan or debtor to the another person to collect. But in non-recourse factoring, the company has no obligation to pay. Now in recourse factoring, what happened? The burden of bad debt is within the company itself in case if debtors default. And in non-recourse factoring, the burden of bad debt is not on the company in case the debtors default. Means the burden of bad debt is not with the company in case debtor default. The burden of collection is shifted on third party or factors in case of default. Suppose in non-recourse factoring, what happened? The company is not liable to pay. He has shifted his burden to the third party or the factor and the default. If collection in default is there also, the factor is responsible for that, not the company. So in this case, the burden of bad debt is not with the company in case debtor default. Accounting entry in the books of A Limited in recourse factoring. How accounting is to be done in case if the company opt for recourse factoring. So in our case, we had means A Limited had sold a goods of 1000 to B Limited and discounted that bill to the from the bank. So entry will be bank account debit by 900 to financial liability in the books of A Limited because he has discounted that debtor from bank, and that 100 rupees is treated as a finance cost because he has paid this as bill discounting charges to the bank. So finance cost account debit by 100 rupees to financial liability. In case when debtors pay, when actually the debtor will pay, then he will reverse the liability. So financial liability account debit to debtors account by 1000, and that liability is to be paid to the bank. And if it is not paid, then if it is not paid by debtor, if debtor defaults, is financial liability account debit by 1000 to bank. So debtor remain in the books, and if debtor default in making payment, then they will create a provision. In non-recourse factoring, what happened? De-recognize. Firstly, he will ultimately, he is not responsible. So, whenever he enter into a non-recourse factoring, A Limited de-recognize the debtors because he has shifted his burden to another person. And what he do? He makes an accounting bank account debit because he had discounted a bill of 1000 and receive only 900. So bank account debit by 900, loss on derecognition account debit by 100 to trade receivable to debtors account by 1000. So he derecognize the debtor because in recourse factoring we will treat as a finance cost, but in non-recourse factoring we will treat it as a that 100 rupees we will treat it as a loss on derecognition. This concept of factoring is to be explained with the help of some illustration. Illustration 1. The company Sun Limited assign its trade receivable to Axis Bank Limited. Assign its trade receivable to Axis Bank Limited. The carrying amount of trade receivable is rupees 10 lakh. The consideration received in exchange of these trade receivable is rupees 9. The customer has been instructed to deposit the amount directly in the Axis Bank Limited account. Axis Bank Limited has non-recourse to Sun Limited. That is, if the debtors fails to make payment to bank, then bank has not able to collect from Sun Limited. So customer has been instructed to deposit the amount directly in the Axis Bank Limited account. Axis Bank Limited has non-recourse because he follow non-recourse to Sun Limited. That is, if debtor fails to make the payment to bank, then bank has not able to collect from the Sun Limited. So in this case, the non-recourse factoring is there. So how accounting is to be done? Accounting in the books of Sun Limited, that is, the trade receivable is 10 lakhs and the consideration received in exchange of trade receivable is 9 lakhs. So bank account debit, Sun Limited will receive only 9 lakhs and treat 1 lakh as a factoring expense, which will be debited to P&L account by 1 lakh to trade receivable 10 lakhs. And that 1 lakh is to be transferred to PL account debit to factoring expense. Now accounting in the books of bank, Axis Bank Limited, He will receive the debtor by 10 lakh, receivable account debit 10 lakh. He pay 9 lakh to the Sun Limited and treat 1 lakh as a factoring income, because in case बैंक का तो income हो गया ना 1 लाख का. Entity C Limited enter into a debt factoring arrangement with D Limited, that is factoring company. Under the terms of arrangement, the factoring company D Limited agrees to pay 91.5 crores less servicing charge of 1.5 crore and a net proceed of 90 crore in exchange of 100% of cash flows from short-term receivables. The C Limited has a receivable in his book whose face value is 100 crores and a carrying amount of 95 crores. The C Limited has also created a provisions of 5 crore in his book. The customer has been instructed to deposit the amount directly in the D Limited factoring company's account. Entity C Limited has also given a guarantee under which it is reimbursed any credit loss over and above 5 crores. Face value of guarantee is given, that is 5.5 crores. So in this case, entity D Limited is a factoring company who has taken a trade receivable of 95 crores from entity C Limited and given a net proceed of 90 crores, and the company entity C has also making a provision of 5 crores, and the guarantee is given by the out if any amount is more than 5 crores, then it will be reimbursed. So entity C has also given a guarantee under which it is reimbursed any credit loss over and above 5 crores, and face value of that guarantee is 5.5 crores. So accounting entry in the books of C Limited. Firstly, he has received 90 crores from factoring company and given a trade receivable of 95 crores, and the balancing figure is to be treated as a factoring expense. So bank account debit by 90 crores, factoring expense account debit by 5 crores to trade receivable 95 crores. He has de-recognized that trade receivable or financial asset from its books. Then he has recognized the another financial asset because he has collected the provision amount also which he has created in his book. So he has recognized the financial asset as continuing involvement in financial account debit by 5 crores to guarantee given. So guarantee liability 5.5 crores. So this concept is the another concept that is the regular way of purchase of financial assets. So there is a two accounting in this case, that is the trade date accounting and settlement accounting. तो ट्रेड डेट में कैसे अकाउंटिंग करते हैं और सेटलमेंट डेट में कैसे अकाउंटिंग करते हैं. तो अकाउंटिंग needs to be carried out on trade date, that is on the date of when the person enter into a transaction, and a settlement that when the person settle the transaction, that is if the person enter into a transaction and if the settlement happen in a future date, so in that case how accounting is to be done, and trade date when the person enter into the transaction. So accounting in the books of buyer, how accounting is to be done in case of in the books of buyer on the trade date, and accounting in the books of buyer on the settlement date. Today we will going to discuss both the accounting on the date of trade and on the date of settlement. In the books of buyer also, in the books of seller also. So firstly we are going to discuss the trade date accounting, that is the date on person enter into a contract, the buyer enter into a contract with the seller. So accounting needs to be carried out on how accounting is to be need to be carried out on the trade date. Accounting in the books of buyer, that is on the trade date. Initial recognition, initially it is to be recognized. Any financial asset is to be recognized as fair value. Financial liability is also recognized as fair value, as we have discussed. Subsequent recognition, as we had discussed that any financial asset which is recognized at fair value, whether it will be recognized at amortized cost or FBT, OCI or FBTPL. So subsequently it follows as per INDAS 109, like financial asset if recognized at amortized cost, then subsequently it will also recognize as subsequent amortized cost only. If it is recognized at FBT OCI, then subsequently it will be recognized at FBT OCI only. And in initial recognition, if it is recognized at FBTPL, then subsequently it will be recognized at FBTPL. So it will follow INDAS 109. Liability also in the it will follow 109 concept, like if it is recognized at amortized cost, then subsequently also it will be recognized at amortized cost. If it is recognized initially at FBTPL, subsequently also it will be recognized at FBTPL. And any gain or loss on the settlement date shall be adjusted to P&L, because ट्रेड डेट में कोई सेटलमेंट होता नहीं है, बट एनी गेन और लॉस ऑन सेटलमेंट डेट में अगर कुछ होगा तो वो एडजस्ट हो जाएगा P&L. अब सेटलमेंट डेट अकाउंटिंग कैसे होता है, दैट इज द डेट इट विल बी सेटल्ड ऑन द फ्यूचर डेट. सो सेटलमेंट डेट में जब accounting is to be done, how accounting is to be done on the settlement date in the books of buyer. Settlement date as the asset is acquired. Settlement date as the asset is acquired on the settlement date only and not on the trade date. So initial recognition, it will be recognized at fair value only, and liability is also at fair value. Subsequently, recognize as it follows INDAS 109. Financial asset and liability. Any gain and loss shall be adjusted to P&L. Now, accounting entry in the books of seller, that is trade date accounting. De-recognize the financial asset. Recognize the receivables. Gain or loss to be recognized in P&L account. An accounting entry in this case will be receivable account debit. Loss of de-recognition account debit. In case if there is a loss on de-recognition to financial asset, and in case there is a gain to gain account. And the same entries of seller in case of settlement date. On the date of settlement, same accounting entry is to be done in the books of seller, that is de-recognize the financial asset, recognize receivable, recognize the debtors, gain or loss to be recognized in P&L account. Accounting entry is to be receivable account debit, loss if there is a loss, then loss account debit to financial asset. If there is a gain, then gain on de-recognition. So receivable account debit, loss account debit to financial asset to gain. And this gain or loss in P&L account is to be recognized in P&L account. Now note, it depends on the management decision whether they will adopt the trade date accounting process or settlement date accounting process. Grace period for settlement in stock exchange. In generally Bombay Stock Exchange, generally grace period is given. That is generally the difference between the trade date and the settlement date is the grace period. That is T plus 2 days excluding Saturday and Sunday. T stands for trade date. T plus 2 days stands for additional 2 days for settlement. Where a contract for purchase of financial asset has been entered with the broker as per the terms of exchange, where the contract entered with the broker for purchase of financial asset as per the exchange terms and terms, as per the exchange or SEBI's terms, then such contract shall be accounted as per regular purchase or sale of the financial asset, but other than that it will be treated as derivative. When it will be entered with the broker as per the terms of SEBI, then it will be accounted as per regular purchase sale contract, but otherwise it will be treated as a derivative contract. This concept is explained with the help of example. Suppose X Limited enter into a contract to purchase financial asset of rupees 15 lakhs from Y Limited on trade date, that is on 1st January 2023. Fair value on the date of settlement of financial asset is 4th January 2023 is the date of settlement. The fair value on the date of settlement, that is on 4th January 2023, it becomes the amount is 15.5 lakhs. Amount to be recorded for financial asset will depend on how it is to be classified, whether the trade date or the settlement date accounting is to be used. So, which accounting is to be used, whether trade date accounting or settlement date? Pass the journal entries. Now, we are using both the accounting in these example. So, solution accounting in the books of buyer, that is the X Limited, using trade date. We are using trade date accounting. So, in the books of buyer, how we are accounting? Suppose buyer is purchasing a financial asset on 1st January 2023, because there is a recognition process, that is the at amortized cost at FBTOCI and FBTPL. So, on the trade date they will account when they will follow, if they are following amortized cost, so it will be accounted as per amortized cost. If they are following FBTOCI, then it will be recognized at FBTOCI, and if they are following FBTPL, then it will be recognized at FBTPL. So on, we are explaining three recognition process. So financial asset account debit to financial liability at amortized cost, that is 15 lakhs. And in the same way we will recognize at fair value through OCI and fair value through P&L. On 4th January 2023, that is on the settlement date, financial liability is to be reversed because that liability is to be settled or paid. So, financial liability account debit to bank. In case of amortized cost, we are recognizing at fair value, and we are settling at the amortized cost only. So, there is no gain or loss in this case. So, that amount financial liability is reversed, and whole amount 15 lakhs is to be paid. But in case of FBTOCI and FBTPL, we will pass two entries, like firstly we will pass on 4th January 2023 financial liability account debit to bank by 15 lakhs, and because the fair value on that date is 15.5 lakhs, so that 0.5 lakhs, that is the 50,000, is transferred to OCI or P&L. Financial asset account debit by 50,000 in case of FBTOCI to OCI, that is 50,000. And in case of ABTPL, financial asset account debit by 50,000 to ABT to P&L 50,000. So in these way the accounting entry is to be done in using trade date accounting. And in case if the accounting is done in case by using the settlement date accounting in the books of buyer, so how accounting entry is to be done? On the initial recognize, there is no such recognition, because we are using the settlement date accounting, and we are assuming that settlement date is as such the transaction takes place on that date only. As we had discussed in our theory, accounting in the books of buyer, settlement date as the asset is acquired on the settlement date. So, on the account trade date, there is no such accounting. On 1st January 2023, when they enter into a transaction, no accounting entry is to be required to be done in the books of buyer by if they are following settlement date accounting. But on 4th January, when actually settlement happen, they will recognize financial asset account debit by 15 lakhs to bank. On that date they will recognize, and that date they will settle, and in amortized cost. And in FBTOCI they will recognize financial asset account debit 15 lakhs to bank 15 lakhs, and that balancing figure, that is 0.5, because on settlement date the amount of financial asset, the fair value of financial asset is 15.5 lakh, but in amortized cost they will settle at amortized cost only. They will not recognize the gain, but in FBTOCI and FBTPL they will recognize the gain or loss. So financial asset account debit 15 lakhs to bank account 15 lakhs, and in case FBTOCI it will be transferred to OCI 50,000. And in case of FBTPL, financial account debit to bank to P&L, that is 15, 15 and 50,000. Means in case of amortized cost, asset to be recognized as if it is purchased originally on the trade date. And in case of FBTOCI, FBTA asset to be recognized on settlement date at fair value. Now we are going to discuss the another example related to regular way contract, that is the forward contract. In these we are explaining with the help of example, that is ST Limited enter into a forward contract to purchase 10 lakh shares of ABC Limited. ST Limited enter into a forward contract to purchase 10 lakh shares of ABC Limited in a month time, that is within a month. The period of enter into a forward contract for 1 month, for 1 month to purchase the shares of ABC Limited, means they will purchase the shares of ABC Limited within a period of 1 month for rupees 50 per share. The contract is entered into with a broker. These contract is entered by ST Limited to purchase the shares of ABC Limited with the help of a broker, Mr. AG, and not through regular trading mode in a stock exchange. Means they are not entered this transaction with their general purchase sale transaction by demat account. They had purchased, ST Limited enter this transaction with the in order to purchase the shares of ABC Limited, in which the broker is involved. Means broker, with the help of broker they had purchased to purchase the shares of ABC Limited, not from the stock exchange directly. The contract required Mr. AG to deliver the shares of ST Limited upon payment of agreed country consideration. Means AG will deliver the shares to ST Limited upon the payment of agreed consideration, and agreed consideration is 10 lakh shares at the rate rupees 50 per share. Shares of ABC are traded on stock exchange also, and regular way of delivery of these shares is 2 days. As is the forward contract. So in this case, the forward contract is not regular way transaction, because why it is not a regular way of transaction, because in previous example we had discussed about the regular way transaction, which takes a grace period of t plus 2 days. But in these this is not a regular way of transaction. This is a forward contract, hence must be accounted as derivative, because the time period between the entering the contract and the time period between the delivery of the contract, time period is more than 1 month. So it is within 1 month. The time period taken to execute the contract, means to enter into a contract, there is a huge gap between the entering the contract and between the settlement date, between the delivery of the contract. So it will almost 1 month to deliver the contract, and it will be treated as a derivative transaction. It will be not treated as a regular way of transaction. So in this case, it is a forward contract. It is not a regular way transaction, and hence must be accounted as a derivative, because the date of entering into contract to the date of delivery is almost 1 month, and in that case all the fair value changes are recognized, because due to that the fair value change, and that fair value changes is recognized in the profit and loss. On the other hand, if the forward contract, suppose if the forward contract is a regular way transaction, such fair value change are recognized in OCI. If the share of ABC Limited are equity instrument and not held for trade. It is not held for trading. Any change on fair value is to be recognized in profit and loss account. And if the shares are equity instrument and not held for trading. If it is held for trading, then it will be recognized in profit and loss account. But if it is not held for trading and it is treated as an equity instrument, not held for trading for day-to-day activity by, and it will be treated as investment in equity shares, then it will be any change on the fair value is to be recognized in OCI. And if it is held for trading, then the change in fair value on that instrument is to be recognized as profit and loss. Now, de-recognition of financial assets. When it should be de-recognized. Suppose A Limited sold goods to B Limited for rupees 1 lakh for 3 months credit period. So A Limited had sold goods to B Limited. So A Limited will, in the books of A Limited, accounting entry at the time of recognition, what they will do, because A Limited is selling that goods to B Limited. So A Limited will recognize trade receivable account debit to sell by 1 lakh. Because the goods are sold on credit basis, that is for 3 months period. After 3 months, when A Limited will receive the payment, then he will de-recognize that financial asset which he has created. That is the debtor which he has created in his books. He will de-recognize that and recognize the amount receivables. That is bank account debit 1 lakh to trade receivable 1 lakh. So he will make debited by bank account debit by 1 lakh and credit the trade receivable which is earlier at the time of recognition he has debited. So in this way, firstly he will recognize the financial asset, then he will de-recognize at the time of receipt. Now another example of de-recognition of financial liability. This we have discussed about the de-recognition of financial asset. Now we are discussing about the de-recognition of financial liability and extinguishments of financial liability. Extinguishments means this concept is explained with the help of example. Suppose A Limited sold goods to B Limited for rupees 1 lakh. Accounting entry in the books of A Limited, that is because B Limited is standing in the books of A Limited as trade receivable. Because A Limited has sold goods to B Limited, so in the books of A Limited, B Limited is a trade receivable. And accounting in the books of B Limited, in the books of B Limited, A Limited is trade payable. That is, in the books of B Limited, A Limited is a creditor, and in the books of A Limited, B Limited is a debtor. Now the accounting entry in the books of A Limited, that is B Limited account debit to sell, that is debtor account debit to sell by 1 lakh. And at the time of recognition and at the time of de-recognize, when they will de-recognize, when they actually receive the payment, so they will then that time they will de-recognize the debtor, the financial asset which they had recognized earlier. So bank account debit by 1 lakh to B Limited, to debtors account. And in the books of B Limited, they will create a liability because they had purchased a goods from A Limited. So purchase account debit to A Limited, that is trade payable. It's create a liability, financial liability by 1 lakh. And at the when they will de-recognize, when they actually pay the liability, that is the A Limited account debit, that is creditor account debit by 1 lakh to bank. In the case of A Limited, it will be a financial asset. In the case of, in this example, A Limited, in the books of A Limited will create a financial asset, and in the books of B Limited he will create a financial liability. In case when the liability is paid, it will be de-recognized from the books. In case when the liability is paid, it is de-recognized from the condition. When liability is to be de-recognized, what was the condition when the liability is to be de-recognized? Financial liability shall be de-recognized when the obligation mentioned in the contract is discharged by the entity, cancelled by the entity, or expired by the entity. Financial liability shall also be discharged when the other party is legally discharged from obligations. Now, accounting entry in case of loan taken from a bank. In case of loss on settlement, if the loan is taken from a bank, and in case there is a loss on settlement, on the settlement there is a loss, then what accounting entry is to be passed? Financial liability account debit, that is the carrying value. Loss on settlement account debit, that is the balancing figure, to bank account, that is the settlement amount. In case of gain on settlement, what accounting is to be passed? That is financial liability account debit by carrying value to gain on settlement account, that is the balancing figure, to bank account, that is the settlement amount. What do you mean by debt restructuring? Evaluate that the change in terms of contract results into substantial modification. If the modification is substantial, restructuring means modification in the contract. If the modification in the contract is substantial, then what we will do? And if it is not substantial, in case of restructuring, then how it is to be accounted for? These standard guides us. So in case of restructuring, if the restructuring or change takes place in the contract and that change is substantially modified, how we will say that it is a substantially modified? We have to check some process. If the process is as per the standard, then it will be treated as that the change is substantially modified. So what do you mean by substantial modification in case of debt restructuring? Firstly, we will find the difference, that is the present value of modified liability as per new terms computed at original EIR. Find out the modified liability as per new contract, new terms of contract computed at ओरिजिनल EIR. ओरिजिनल इफेक्टिव रेट पे हम लोग कंप्यूट करेंगे नया टर्म्स के हिसाब से मॉडिफाइड लायबिलिटी. Suppose Mr. X has taken a loan from bank for 10 years, or Mr. X has modified the or restructure the period, that is from 10 years he will reduce the period of loan, like from 10 years he reduce it to 8 years, or he will increase the interest rate, or he will increase the EMI. Restructuring happen, and whether we have to evaluate whether these change results into a substantial modification or not. So how we will evaluate? So firstly, we will check the meaning of what do you mean by substantial modification. Firstly, we will check the difference between the present value of modified liability, the new liability as per new terms of contract computed at original effective interest rate. एक्चुअल में ओरिजिनल कॉन्ट्रैक्ट बना था, जो फर्स्ट टाइम जब कॉन्ट्रैक्ट बना था उस पे जो इफेक्टिव इंटरेस्ट रहता है उस पे देन इट विल बी रिड्यूस फ्रॉम द प्रेजेंट वैल्यू ऑफ ओल्ड लायबिलिटी. ओल्ड लायबिलिटी जो है प्रेजेंट वैल्यू उसका जिस दिन एंटर किए कॉन्ट्रैक्ट एज पर ओल्ड EIR, दैट इज बिफोर मॉडिफिकेशन, जो प्रेजेंट वैल्यू पड़ा है बुक्स में उसका प्रेजेंट वैल्यू ऑफ ओल्ड लायबिलिटी निकालेंगे एज पर ओल्ड EIR, दैट इज बिफोर मॉडिफिकेशन. डिफरेंस निकाले. Step 2, divide the difference with the carrying value of old liability as per old EIR, that is before modification. Check the difference. If the difference is greater or equals to 10%, अगर इन दोनों का difference 10% या 10% से ज्यादा है, then it will be treated as a substantial modification. In case if it is a substantially modified, case, in case of substantial modification, extinguishment accounting will apply. But if the difference is less than 10%, then it will be treated as that it is not substantially modified. In this case, modification accounting will apply. Then recognize new liability at fair value at new EIR. Then difference between the carrying value of existing liability and fair value of new liability to be recognized in P&L. Then transaction cost incurred on new liability shall be adjusted in the value of new liability only. Any transaction cost incurred on payment of original liability shall be charged to P&L as gain or loss on. So these are the steps to apply extinguishment accounting in case of substantial modification. Firstly, the first accounting entry is to de-recognize the existing liability at carrying value. Another accounting is recognize the new liability at fair value at new EIR. Difference between the carrying value of existing liability and fair value of new liability. The difference between these two is to be recognized to P&L. Any transaction cost incurred on new liability it shall be adjusted with new liability only, and any transaction cost incurred on payment of original liability shall be charged to P&L as gain or loss on. Now, in case when the modification is not substantial, there are two approaches. Means in case of modifying accounting, when the transaction is not substantial, there's two approaches. Recognize gain and loss in P&L on modification date. Accounting entry in case of gain, that is financial liability, existing liability, account debit to gain on modification to financial liability, that is new liability. In case of loss, financial liability, that is old existing liability, account debit, loss on modification account debit to financial liability, that is new liability. This is the modification in. The above gain on loss on modification shall be charged to P&L. There's two approaches. First approach is we had discussed. The second approach is amortize modified gain or loss over the remaining contract period. Recompute the new EIR. New EIR is used to compute the value of financial liability subsequently. Firstly, we will amortize the modified gain or loss over the remaining contract period, then recompute the new EIR, and that new EIR is used to compute the value of financial liability subsequent period. This concept is explained with the help of example. We will explain the concept of extinguishment accounting and also modification accounting. Suppose on 1st January 2023, XYZ Limited issue 10 years bond for 10 lakhs. That 10 lakhs is bullet repayment. Rate of interest is 10%. Interest is paid annually every year. The bond is redeemable on 31st December 2032 because after 10 years the bond is matured. And the redemption value is 10 lakh, that is bullet repayment. Market rate of interest of similar bond is 10%. On 1st January 2028, that is before maturity, XYZ Limited enter into a modification contract with the bondholder. The terms of bond has been extended to 2 additional years and the rate of interest is increased from 10% to 11%. Market rate of interest of similar bond is 11%. XYZ Limited also incurred a legal charges in order to enter into a modification contract. The bond is redeemable on 31st December 2034 at rupees 15 lakh. Bullet repayment is to be made. The rate of interest at that time when they enter into original contract is 10% and the bond is redeemable on 31st December 2032 and the redemption value is 10 lakh. Market rate of interest of similar bond is 10. These details is related to original contract, but on 1st January 2028, X Limited enter into a modified contract. He had extended the period from 10 years to 12 years, and he also increased the interest rate from 10 to 11%. And at that time, when he entered into a modification contract, they incur some legal charge, and bond is redeemable at rupees 15 lakhs. So there is a change in contract. Contract is modified, or there is a restructuring happens. Now we will check whether this restructuring is substantially modified, or it will not substantially modify. So firstly, we will evaluate the original contract. That is, original contracts XYZ Limited issue bond amounting to rupees 10 lakhs on 1st January 2023. Rate of interest of bond is 10%. Period of bond is 10 years. Effective interest rate of similar bond is 10%. Interest paid annually is 10 lakh ka 10%, that is 1 lakh per annum. Now step 2, evaluation of modified contract. That is, after 5 years, that is on 1st January 2028, XYZ Limited modified the bond contract by rupees 15 lakhs, and it is redeemed at rupees 15 lakhs. Rate of interest of bond increased to 11%. Period of bond increased to 2 years. Effective interest rate of similar bond is 11%. Remaining period left is 7 years instead of 5 years, because previously the bond is for 10 years, but now in modified the bond is extended to 2 more years. So the remaining period is 7 years. After 5 years, if the bond is modified, after modification the remaining period is 7 years instead of 5. Step 1 is to be evaluated. Firstly, we will check whether it is modified or not, it is substantially modified or not. For that, we will have to compute the present value of liability as per new terms computed or original EIR for remaining period, that is 7 years. Calculation is done on the date of modification. On the date of modification, we have to calculate the present value of the liability as per new terms, as per new conditions, and we will compute that new liability by taking the original EIR, by taking the original effective interest rate for the remaining period, because 5 years are already lapsed, and modification takes place after 5 years. So remaining period is, and in case previously it is 10 years contract, now it will be extended to 2 more years, so it becomes the remaining period left is 7 years. So in year 1, 0, 1, 2, 3, 4, 5, 6, 7, principal amount, interest, legal cost, that is the transaction cost, present value at the rate 10%, and present value. So year 0, 1, 2, 3, 4, 5, 6, 7. Principal is in the 7th year, it should be paid in full. That is, it is modified from 10 lakhs to 15 lakhs. So in 7 years, it becomes 15 lakhs. And interest is to be paid on 10 lakhs. It should be paid at the rate 11%. That is, the rate of interest is increased to 11%. So it becomes 1,10,000, because the new effective rate is 11%. Legal cost is 1 lakh. Legal transaction cost, because it is incurred at the time when the modification takes place, then only the 1 lakh will incur as a legal charges. So it will happen after 5 years. So from 5 years, after 5 years, the modification takes place. So, and incurring by incurring a transaction cost on that date, so 1 lakh is on the 0th date, and for the remaining period we have to calculate. And present value is to be calculated at an old effective interest rate. Old effective interest rate is 10%. So present value is to be, we have to discount this principal and interest and cost by taking the old effective interest rate. So old effective interest rate is 10%. So present value factor at the rate 10%, we have to compute that of 0 to 7 years, and then we will multiply the principal plus interest plus legal cost into present value factor. So it becomes the present value of the liability as per new terms computed. So as per new terms, so in 0th year there is no such present value factor, because in that year the modification takes place. So 1 lakh into 1, that is 1 lakh only, it will be reduced from the value of the liability, because transaction cost is always reduced from the value of liability. Then interest, there is no such principal repayment. Repayment happen at 7th year, only interest is to be paid. So interest is to be computed by using the present value factor. So 1 divided by 1.10, it becomes 0.909. So 1 lakh 10,000 into 0.909, so it becomes 1 lakh. In the same way, we had to calculate in the 7th year the principal plus interest is to be paid. So principal is 15 lakhs, interest is 1 lakh 10,000, present value factor is 0.51315. So it becomes 8,26,184. So total present value of the liability as per new terms 12,05,263. Now in step 2 we have to compute the carrying value of old liability. For 5 years what was the carrying value of the old liability, we have to compute before modification. We had entered a transaction for 10 years. The bond value is bond is repaid at a bullet repayment is there of 10 lakhs, and interest is to be paid on that value at the rate 10%. So 1 lakh is to be paid as interest every year. Carrying value of old liability as per old effective rate before modification becomes present value factor at the rate 10%. So it becomes 10 lakh, because 1 lakh is the interest. 1 lakh into present value factor, whatever we had computed to determine the present value. So 90,909 total after 5 years. In this case, because 10 lakh is the principal and interest is total, is become 15 lakh. But we have to determine, pull it out today, what was the value. So by using present value, discounting at a present value factor, it becomes 10 lakh. Now we will compare that evaluation of substantial modification on the date of modification, that is on 1st January 2028. The present value of modified liability as per new terms computed at original effective interest rate is 12 lakh 5,263. उससे हम लोग रिड्यूस करेंगे प्रेजेंट वैल्यू ऑफ ओल्ड लायबिलिटी एज पर ओल्ड इफेक्टिव रेट बिफोर मॉडिफिकेशन, दैट इज 10 लाख. डिफरेंस इज 2,05,263. सो परसेंटेज निकालना पड़ेगा. परसेंटेज ऑफ चेंज इज 2,05,263 डिवाइडेड बाई 10 lakhs. So it becomes 21%, which is more than 10%, which has a substantial modification. Now this results into a substantial modification. So in case if there is a substantial modification, then we have to apply extinguishment accounting. So computation of present value of new liability at the rate 11% for the remaining period. So 0 to 7 years is the remaining period. Principal is 15 lakhs is to be paid in the 7th year. Interest is to be calculated at 10 lakhs ka 11%, that is 1 lakh 10,000 every year. Legal cost is on the date of modification they incur. So it becomes 1 lakh. We have to pull it out with 11%, discount it by 11%, which is the new effective interest rate by using new effective interest rate. So present value factor or present value of that new liability is 11,40,829. So we will pass the journal entry in case of extinguishment accounting, because the modification takes place which is substantial, which is more than 10%. In our case it becomes 21%, which is a substantial modification. So accounting entry is we will apply extinguishment accounting. So in this case, financial liability, that is existing, whatever the existing liability is 10 lakhs, and new liability is 11,40,829, and the differential is to be Whether it's a profit or loss, in our case it will be a loss because the new liability increased, and because the old liability is 10 lakhs, new liability is 11,40,829. So differential 1,40,829 is the loss on modification account debit. That is the balancing figure. Note, modification accounting to be done in the year of modification. When the modification happened, on that date only, in that year only, modification accounting is to be done. It does not matter whether it occurs before financial statement, whether it will be approved by from the shareholders or after. It will be accounted when in the year in which modification takes place. Means if it will takes place after 31st March, then it will be accounted in that year only. And if the modification happened before 31st March, so it will be accounted in the year in which the modification happens. So it doesn't matter of approval. It does not require any approval from the shareholders to recognize the modification. Now debt for equity swap means when financial liability get converted into equity share. Debt equity swap means when the liability is converted into equity share. Suppose this concept is explained with the help of example. Suppose X Limited has taken loan from bank amounting to rupees 10 lakhs for 10 years at the rate 10%. But after 6 years, X Limited has decided to convert that loan into equity shares because he don't have he has some finance crunch, so he don't able to pay to the bank the balancing amount. So he decided that he will issue his shares to the bank for the balancing amount. Accounting entry under these cases: financial liability, that is account debit, accounted for carrying value. Loss on settlement account debit, to equity share, to security premium, and to gain on settlement. Any gain on settlement is there. Note, these accounting does not apply where creditor is a shareholder. Where the creditor is a shareholder, these accounting will not apply. These accounting will not apply where creditor and entity are controlled by the same entity. Means if the creditor and the entity are controlled by the same entity, this accounting will not apply. Means if the group company is there, if debtor is a director of that company is a creditor, then these accounting will not apply. And these accounting will not apply where issuance of equity share is a part of original contract. This concept is explained with the help of example. Suppose JK Limited having an outstanding amount of rupees 120 crores with Bank Limited. Means JK having an outstanding amount of 120 crores. The effective interest rate of loan is 10%. JK Limited decided to convert two-thirds of the outstanding loan into equity share, and remaining one-third of the outstanding loan goes for moratorium period. These two-thirds of debt, due to its unsustainability, converted into 70% of equity interest in JK Limited, and the fair value of net asset is rupees 100 crore. One-third of the debt is sustainable and bank agrees to a certain moratorium period. The present value of the cash flows as per the revised term is 31 crores and original term is 28 crores. Show the journal entry. Solution: amount outstanding loan is 120 crores in the books of JK Limited. Two-third, there is two part of accounting. Firstly, we will discuss the part 1 accounting, that is two-third of the loan is converted into equity shares. So it becomes debt equity swap because the loan is converted into equity. Two-third of the loan is converted into equity. So in this case, in part 1, debt equity swap accounting is used. So two-third of 120 crore becomes 80 crore. Out of the 80 crores, that is the 70% of equity interest in JK Limited, and the fair value of equity is 100 crores. So fair value of equity which is converted by the by JK Limited is 100 crores. So 100 crores into 70% becomes 70 crores. Now in part 2 we have to make an accounting of, and we will apply extinguishment accounting. How? Because one third of the loan which is facing moratorium period, that is bank has given some cooling period, that is you will take 6 months, after that you will pay. Bank has provided the cooling period to JK Limited. He has to pay because JK Limited is facing some financial crunches. Due to that, bank has given a moratorium period to JK Limited. During this period, company will not pay this amount, but after cooling period is over, the company has to pay the outstanding amount of loan. So in this case, one third of 120 crore become 40 crore. The present value of cash flows as per the revised term is 31 crores. Present value of original term is 28 crores. Change in present value is 3 crores. Difference in percentage is 3 divided by the original present value of original term, that is 28 crores, that is 11%, which is a substantial modification. Now accounting entry part 1, debt for equity swap, that is financial liability account debit by 80 crores. Converted, that 80 crores is to be converted into equity shares of 70 crores, because 70% of the face value of 100 crores. So it becomes 70 crores. There is a gain on settlement. And in part 2, we have to apply extinguishment accounting. So the old liability is 40 crores, that is one third of 120 crores. The new liability is 31 crores. And the differential amount is gain on modification. So financial liability account debit by 40 crores to financial liability new, that is 31 crores, and the differential amount is to gain on modification by 9 crores. We had completed mostly the concept of financial instrument. I had discussed, I tried to discuss all the concepts, but only the disclosure of financial instrument is left to discuss. I discussed all the concept related to this standard. So only one video is left for discussion, which is the disclosure video. We will discuss this in the next upcoming video. Thanking you for watching my video. Please share, subscribe my channel.